All right, so Mr. Roboto, please.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker and a registered investment advisor before placing any trade. All securities and orders discussed, tracked, and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither philstockworld.com, CSW, nor its affiliates, nor any of the respective offices. Personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, and registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involve risk. Visit the SEC website www.optionsclearing.com to read characteristics and risks of standardized options. CSW provides education and training services that are meant to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying a guarantee of any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified day. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not refuse to spread your information to anyone.
All right, fantastic. Moving on. Hi, everybody. So, conservative Phil Davis. It's like that episode of Star Trek where everybody had their opposite. All right, so let's see. Yes, thanks. I appreciate that. All right. Up and up. Okay. So where are we? We are down 20,000. That's the most exciting news. Even the futures. 1999. Now, frankly, the futures are the more real trade. So, like, if you're going to be using lines, the line, that you see on the headline on the index isn't really as important as the line in the futures. They're usually close, obviously, but when you see 1999 in the futures, that line means something. And I wish I had a good reason to short the Dow at that spot. I really do. I don't. I mean, that's the thing. Other than technically it shouldn't be that high, I would love a good reason to be able to short the Dow. But for the purpose of this webinar, it's an obvious trade. I mean, if you have for no other reason than you're hitting a significant resistance point. 1380 is actually a good point too. 1385 even better. But we'll ignore the Russell, and we'll just watch the S&P and the Dow. So that's YM. Okay, and we're going to take, you want to nail it on the head if you can. Oh, here's something important. So while I'm looking to enter, I'm looking at these numbers. And what do I see? I see a pretty even stack in both directions. So meanwhile, I'm explaining it and blowing it. The stack in both directions. So I don't really see any particular reason it's going to go up or down. Sometimes, here, see this? Well, you have it on both sides. But sometimes you'll see 100 and something, 80, 90, and then up here you'll see 20, 30, 40. That means that there's more people lined up down here to buy than there are here to sell, and usually that's going to pressure you in that direction. So it's good to look at your bid size and ask size, do a quick count, and see what the resistance is in either direction. Sometimes there's just one big buyer sitting there, and you're not going to get over something until you clear out the big buyer. Oh, here we are again. All right. On over here. Only $5 a point, so I get really bored if I don't have a few. Now, other lines that are useful are these, when you hit the second support. Things don't usually, well, you're already above, but things don't usually go above the resistance line. So you don't usually go above, this is resistance. See, this is your base resistance 1, resistance 2. Here's support 1 and support 2. You don't usually go above, that's called standard deviation. You don't usually go above 2 standard deviations in one day. That's extremely unusual. It's not a strict percent. These vary. The amount of the varies can go up and down each day, so you can't say it's a certain amount. In this case, it's about 0.75%. But you don't usually get so far outside these lines. Now, What we're watching on the NASDAQ, what's the S&P? On the S&P, we want to see 2280 ES. 2290. We'd like to see 2290 not be over, and it is, so that's bad for the Dow short. We certainly don't want to go over this line, though. Don't forget, we don't take the Dow as seriously as we take the S&P. The S&P is a much more serious index. It's all big cap companies. You can't just it's harder to fake the S&P. Now, right now, Boeing is Boeing. Charts. Apple, look at first of all, Apple is up. Well, officially, Apple's up 2 for the day, basically. Boeing is up 8 points. Now, 8 points times 4 is 32 points. So 32 points is Boeing, just Boeing stock. Apple is another 16 points, so that's 48. So Apple and Boeing, just those two stocks, are half the Dow's gain for the day, or a third of the Dow's gain for the day. Now the thing is, I don't have any reason particularly to think they're going to go down. Why would Apple sell off? Why would Boeing sell off? No particular reason. So I'm not saying this is saying technically, though, when you're below the line, and especially trying it for like the first time, first day trying to make this line, when you're below a line that's this significant, like 20,000 on the Dow, you have a better chance that it's going to go back down than it's going to keep going up. And, of course, if you play with tight stops, how much could you really lose? So at the moment, I'm willing to go to 16 because it went to 16 once. I'm willing to see 16 again. Or if the S&P punches over its high at 2293, then I would bail. But at the moment, I'm more inclined to add. My average is 1996, so I want to. I'm 4 points. I'm 3.5 points. I'm 4 points under my goal of being short of 20,000. I'd like to add 2 when we're 4 points over. That will add to 20,000 line. And then the rest is just tedium. This is how you trade the futures. You pick a spot that you have a good, comfortable stopping out point. You have multiple other things you can look at, like I want to see if oil bounces. I know oil is important. I want to see what the big gasoline off for now. We'll punch in here. And we want to see, now what do we want to see? We want to see the dollar going up. If the dollar is going up, it's going to put pressure on the indexes. If the dollar's going down, it's going to let the indexes rise more. Now, the dollar pretty much held 100. When it spiked below it, but we don't care about that. It pretty much held the line at 100. And that's a good sign. So it's probably just kind of squeaking on here. Again, when you're at a resistance line, I have to say, is there any particular reason I think the dollar would be below 100? And there's not. I don't really see any good reason the dollar should be below 100. So since I can't think of any reason it's going to go below, spikes below 100, and there's no particular news, I have to say, well, you know what? Maybe that's just going to come back pretty quickly. And that's another good reason that you can play on these lines, because if you had faith that 100 would hold, you could actually make money by adding position as it goes down here, taking advantage when it comes back up, and then just making money while you wait. And the same goes to the S&P. Again, 2290. There's nothing magical about 2290. I'm just using the support line here, but 20,000, is a serious psychological level. And I'm looking at the Dow on the TV. It's at it's 2295. The S95 on the main index. NASDAQ 5846 on the main index. So 5850, of course, is going to be a resistance point. And the Dow itself is at there it is, 82. So the Dow is 82. So basically, if it gets over here at 2016, that's 20,100. That's where it fell before, 21,100 on the main index. But I'm cheap right here. I want to see if that fails. Keep an eye on the dollar. Keep an eye on oil. See what oil's doing. Oil's obviously silly. It hit our goal here for shorting at 53.50, and it came back down to almost 53. It actually fell really fast to 53 here, then it bounced back up and it came back down. But no, oh, we should look at the inventory though. Hang on. Q&A. All right. So we did the petroleum, P-E-T-R-O. Petroleum station. See what the hell happened. All right. Inventory is 2.8 million barrel bill there. Gasoline is shocking. The gasoline up by 6.8 million barrels. And I think distillate is virtually unchanged, yeah. So basically, we have another huge net build. We went from, whoa, I can't read that. What's going on here? Like a bad PDF. That's weird. Still can't read it. Okay, that looks like it was actually more last week total, but you see all other oils. It's hard to see, but it went down. All other oils got another draw. That's been going on a lot. We're back to where we were last year on the level of all other oils. Everything else is built. And overall, 1992 this says, and that's 2028. So it's not up that much from last year, but it is up. And prices are, obviously, we were 30 last year. Now we're at 52. So that's up 70-some-odd% in price. What else happened? We had exports were the same as last week, which is a lot. 3 million days being exported. Wow, these are all hard to read. I've never seen this before. It's all blurred. It's the first week Trump's in office, I guess. Next week it'll be so blurry you can't read any of the numbers. Tillerson's got his eraser out. Inputs to refineries was the same. Refinery utilization was the same. Gasoline production was the same. Distillate fuel was the same. So wait. Distillate fuel production was actually a bit lower. We had to say 100,000 days is lower enough to notice. 700,000 for the week. So distillate fuel went down. Everybody else is the same. Product supplied, gasoline supply a bit lower. 2 million less barrels a day were supplied, and we still had a giant build. Distillate fuel, 100,000 less a day. That's 700,000 here. So here's 1,000 less per day. Here you have 100,000 less per day. That's less being supplied, yet we still have a net product build. And then all other products, they made a bit more of the all other products. On the whole, less products were supplied. So they had less products supplied, and we had a gigantic build in gasoline. That shows a very big lack of demand. Demand is very far down from where it was last year. And this is ongoing. It's not going to change. And people do this, okay? Every time someone buys a new car, that car gets better mileage than the car they're getting rid of. There's almost no cars that you're going to be bringing in. I mean, obviously, if you go from getting a Hyundai to an SUV, then that changes it. But a normal person changing their car for the newer model is going to get better mileage. And a lot of people, very significantly better mileage. There's a mandate. So the fleet that we have now averages 21 miles per gallon. All the old cars, the fleet average is 21 miles per gallon. The new fleet average, the average of new cars being sold right now is 35 miles per gallon. They use significantly, like 40% less gas than the old fleet. So every time someone buys a new car, it adds to the overall improvement in efficiency, lowers our demand for fuel, and gasoline is probably 40% of the consumption of oil in the United States is from gasoline. I mean, obviously, look at how much is supplied there. You can see it right there. How much is supplied? 8.5 million in gasoline, 10 million in everything else. Or 11, let's call that 11 million in everything else. So, 40%. Okay, that was pretty easy. Anyway, there's nothing bullish about this report at all. today this is where you are now with all this oil floating around with near record levels of storage, and you've got and the weird thing is and you see here, because see, gasoline reflects the actual demand. So gasoline is up about 40 cents. So that's 20%. Gasoline's up 20%. Oil's up 70%. Got no bearing on reality whatsoever. Have a question? Mike, check my volume is way low. That doesn't make sense. I mean, I don't know if this actually does anything. Just dialed in to filmmaker futures trade. No, I didn't. Yes, I did. Unless that was before. Volume's on your end. Okay. 219.60 still good. I still love that play. I got to tell you, it's not. I read it. There's a million articles on Guild. Somebody yesterday just put out an article on Guild saying that Guild was like one of the best investments in the pharma space. I cannot, and I've read bad stuff about them because look, they have a monster hepatitis C drug that is probably like 40% of their revenue, something like that, and it's past its prime. And they've got competition, they've got generics, blah 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 blah. So yes, that hurts. But even when people have generic competition, this is something you can look at 1,000 examples of. Even when there is generic competition, people still take the main drug. They do it, they know the name, they trust it, the doctors trust it, they get kickbacks or whatever crap, whatever reason, you still sell plenty of the main drug even after the generics come out. All right, Viagra is still a thing. Okay, there's like a million other things like Viagra, but Viagra is still a thing. So they're not going to lose all their business. So, let's say to be fair, you would discount Gilead 20% based on that. And let's say you say, oh, they got another drug that's coming off Schedule 2, and you say, okay, so give a discount 30%, 40%, and assume they're not going to find any other drugs and they won't ever invent anything again. And so far, there's no evidence. This is all I'm talking about. What you discount it based on the fear. But there's no evidence whatsoever that they're actually losing all this business, and there's no evidence that they have no improving pipeline of new drugs. Where's the numbers? Okay. So, $9 market cap, PE of 6. They are making $11 for a $72 share this year. That's below last year. They made $12.60 last year, so woo, dump the stock. I mean, so you put $72 in the bank and get $11.45 back. That's good money. You put $72 in the bank and you get $10 back next year. So there is no reason, and this is their projections. These are the analysts. There's 23 people following them. Number of analysts, 23, and 23 analysts looking at this stock have decided, or 26 or whatever. We're talking about quarters. So 26 people in the year, whatever, are saying, hey, this year, 11.45 target. And the company is obviously guiding that. And the revenues are here, and they're going down about not even 10%. 7%, that's already there. The revenue's down 10%. Now, if you look on the money side, $11 billion, $24 billion, $32 billion. That's good growth. That's like 30-something% growth here, 100% growth here. Profits $3 billion, $12 billion, $18 billion. Now, how are they doing quarterly? Well, it looks pretty consistent. 8, 8, 8. So basically, they're on a $32 billion pace, and right there, $32 billion. So they're basically flat this year that way. Money-wise, 35, 35, 35. So they're on a $14 billion profit pace. That's a bit lower than last year, but higher than it's a bit lower than 15, but higher than 2014. Now, where was the stock in 2014 and 15? It was freaking $100, $90, $80. It wasn't 70. They're making more money than they made here when it was 100, and people bought it up from there. And this was a bit much because you have to think that this growth isn't going to continue forever, and things don't just keep going up. But you get to a certain point down, and you say, well, this is kind of silly now. What I love, and I cannot, I just said that in chat too, cannot emphasize enough what a great stock that is to bet on for the long term. It's just such, compared to all this crap that's being bought in the market, it's a complete value play. It's come down with illegible report. Yeah, I know. It's just another way of not distributing information anymore. Volume 85. Would you recommend a play on TIVA? Well, TIVA's like Guild also. It's also beaten up too much. If we look at TIVA. Oh, by the way, I can't do a long webinar today, so I have to go somewhere. Let's see, TIVA. She's flat. This is what, annual. Annual revenue flat. Profits, well, they had a big thing last year. I think there was a special doohickey. So, $1.5 billion profits. So they're on pace to $20 billion and $1.5 billion is the question, and there's no quarterly numbers here. So I don't know the answer to that. But still, bottom line, if you look at the analysts, and they're going to make $5 a share, basically, a little less than last year. Same goes for Diva. So they're going to make $5 for a $33 share, for a $34 share. Stupidly low. And farmers out of favor because they're killing Obamacare and blah, blah, blah. Oh, wow, Mar-a-Lago just raised their membership fee to $200,000. Trump's little playland in Florida. I can't even believe you can be a member there anymore. How does the Secret Service feel about that? They let anybody who has $200,000 can go sit with the president? Well, you know what? As I say that, I'm like, yeah, oh, of course. Yeah. So if you want to have a meeting with Trump, it's $200,000 to join Mar-a-Lago now. And they say you can be the president. Oh my God, how could he say that? That is crazy. All right. Anyway. So yeah, the same. Guild and TIVA are down for the same kind of reason because the sector's out of favor, but they're both incredible values. And again, you got to compare it to what else is out there. You look at GE, who I like, but not GE. You look at GE, they're making $2 a share. $2 a share is great. Their PE is like 15. But let's look at their financials. Their earnings aren't growing. 113, 117, 117. Their profits aren't growing. 11, 12, 11. There's no difference between GE and TIVA or Guild, really. They're big, giant companies that are going to chug along at a certain level. Yet one or two, the first two are valued at have a PE of 7, and GE's got a PE of 15. You gotta look for bargains, and when you find a bargain, you gotta, why would I not buy this stock? That's really what the question is. When should you roll spread that is in the money, i.e. Disney, the winning, no. Okay, let's take a quick look at that. How's my Dow going? You guys never tell me when I'm losing all my money. Oh, okay, we're here. All right. Oh, I bet I could have sold those extra too, though. All right, whatever. So the S&P got rejected where we wanted to. Dow poked up a little bit, but it came back down. As I said, I wanted to. I should have put a thing in there. I wanted to sell another one. Let's do that so I get my bell. If I sell another one here, then we'll see what happens, okay? All right. So I want to bring my average 1,000, so I just like to have whole numbers, basically. Well, here we go. Since I offered, they seem to be going for it. Oh, look at that. Oh, there it goes. All right. There's one. Now I'm at 1999. So if I have three at 1999, it means if I sell one at 2003, it's going to average me out to 2,000. Now, remember the numbers, though? See the bigger numbers now. 50, 50, 50, 34, 47, 20, 30, 40. So there's bigger numbers here than there. So it indicates, oops, wait, 18 so much, and 18 and 5. Apparently, this is the number I got to go for, though. I'm going to hit that. Oh, got my fill. Now, in theory, that should be the top because now you have a bigger bunch here than you have here. But did not work out that way. And that's because these guys are determined, then these guys get chewed up pretty fast, and you'll see them falling one by one by one. 14. And that's how you figure out who the serious guys are. So this guy's serious. It's this block over here. And by the way, if you're a good trader, you don't show all your cards. You don't offer 10 when you want to sell 10. You don't, and more to the point, you don't offer 1,000 when you're selling 1,000. You offer 10 at a time, 20 at a time. So when they fill, you put more in. You don't want to tip your hand that you've got a large block to try to get rid of. I have to care less than my 2 and 4, but I'm just saying, if the big traders don't do that. That's why sometimes you'll see a deceptive amount. Like you'll see something like 15, but then it stays at 15, even though these guys get chewed up. You'll see this guy staying at 15, and you're like, and that means that what they're doing, they're running a program that refills the short order every time at 15. So they keep it a steady 15 because they don't, exactly for what I'm doing. They don't want people like me to know what they're doing. If people watch this stuff, they don't want that information out there to absolutely selling a huge block at certain price. Like here, even sometimes there's a 1 there for a thing. Even sometimes a 1, you'll see a 1 stay for a ridiculously long amount of time, and then you realize that somebody's messing around with it. All right, but now my average is 2,000, 2,050 in fact. So I'm very happy. I got my level, but over 2016, it stopped it out. And what's going on with my dollar? Where's our dollar? Dollar's up here. It's staying steady, so that's fine. Oil came up a bit. That's not good because I don't want oil to come up. That's a positive for the Dow. And I'll check the news and see if anything's happening news-wise, too. But we'll get to that in a minute. So what were we talking about? All right, Steven stuff. We're done with that. So 90-105 bull call spread. So the question is, when do you roll it? It's not that kind of trade. When you do a bull call spread, you have to realize that you set a position where you're forced to be patient. So I think you said 90-105. So the 90s are 75. So let's say 19. So these are 19. The 105s are 550. So 19 minus 550 is 1350, right? So it's 1350. Now Disney's at 108. So frankly, why would you wait a year to collect $1.50? You can make much more money than $1.50. Okay, with $13.50. If I do the math right, it seems like too much for that kind of trade. 19 minus, well, if you can get it, 19 minus 550. Yeah, that is correct. So the 1350, mostly, now it's not a roll. I'm talking about just killing the position because you've made enough money. You have to wait a year to make 10% more money, tying up 1350. Now, I'm sure you made a lot more than 10% on this trade already. if you can find something better to do with $13.50 than wait a year to collect $1.50, then kill it. That's all. Now, I'm sorry, if you can find something that is relatively safer, of course. I'm not saying take the money and gamble it, but on the other hand, at 108, so you're risking it going back below 105 and losing money too. So you have a certain risk factor. You have to decide how comfortable you are with that risk factor. And then you say, well, I've got $13.50. I can put it right in my pocket right now, or I can wait a year to make $1.50 more if everything goes well. That doesn't sound very sexy. Your $13.50 is at risk. Unlikely as it is that Disney would go down that low. But your $13.50 is at risk, so it's better to just take it off the table when you've made that much of your money, and you can do better. Now, if you still like Disney, I would say, let's say you think they'll go to 120. You can pick up these guys to 18, the 100 calls in 2019, and you can sell the 115s to 10. So then you're at another $15 spread for $9. I wouldn't do that, though, frankly. I don't like the pricing. So I would, based on that, I'd walk away. I wouldn't pay $9 for a $15 spread. They got to be kidding me. I would never pay more than half for a spread. Never. I want to pay me 100% because it's 50% that you're going to win, 50% that you're going to lose. So if they're not going to pay me 100%, it's not a good bet. You have to, no matter how good you feel about a company, no matter how smart you think you are, it's still going to be a coin flip when push comes to shove. Statistically, it's a coin flip. Your edge, of course, is being good at picking things and knowing that this one's better than that one or whatever, so you got a better coin, but it's still going to flip. So you might be weighted on one side, you might have some advantage, but still there's going to be a flip of the coin. You're either going to win or you're going to lose. So if you're not going to win 100%, it's probably not a good bet. Now, that being said, with Disney saying it would go to 120, I'm not 100% confident in that. I think they're really well priced now. They were crazy low earlier in the year. When I was banging the table on Disney, they were below 100, and I said that was silly. But there's a fine line with Disney between, again, because they're like GE. They're not going to go to the moon. But they're down here. They're down like 90. So, and again, it's the same kind of thing. It's the same concept. I looked at the numbers here, and when it went down here, and all year long, I was banging the table on Disney saying whenever it got down in the 90s like this, I said, gotta buy it, gotta buy it, gotta buy it. Because this company, they've got the theme parks, of course, they've got the movies, they've got the hotel business, there's a huge hotel business now. It's just multiple revenue streams in multiple things. They're practically like Berkshire Hathaway. They've got all these different aspects of business, and of course, and ABC TV, ESPN. Now, ESPN's doing badly, but it doesn't ruin the whole thing. It's one division's got problems. And by the way, badly just means they're shedding some viewers due to changes in the cable laws. Trumpy is about to revoke net neutrality, though, which is actually great for Disney. If he backs off on the net neutrality, then ESPN benefits them. So that'll be an interesting concept. But again, no reason to get bullish. You don't get bullish betting on somebody doing something. This is just, we're at a fair price. This was our target for Disney, was 110. So now it's fairly priced. And I wouldn't rebet it. I certainly wouldn't pay that kind of ridiculous premium to rebet it. So I would just cash it in and move on and find something else to trade. And then mark it in your calendar. Put it on your watch list. And if Disney does come down, it goes back to 90, you want to buy it again. That's all. Stocks go up and stocks go down. So, it's just don't, sell them when they go up and buy them when they go down. While we're in biotech, any particular reason my SGYP drop total? I don't understand that myself, frankly. Where are they now? I think it was the way they were approved. Some approvals are better than others. And I don't think that it was approved, but not fully approved or not in the way they wanted to use it. I don't know. the FDA approves something for something, like you file to say, I want to get it approved for doing 10 things, and the FDA says, okay, we'll approve it for 3 things. And again, it's not my field. Farm Boy liked it. I agreed with him because it looked like a good risk. And that's why I like to trade. And I still like to trade because I still think it's a good risk, and there was a huge amount of premium we got paid for taking it. So it works out, and he's right, and the FDA did approve it, and now they basically have to go to the next set of trials and get more approvals. That's all. But as you can see, it's actually quite a nice chart. It's a nice steady move up. It's just up and down and up and down and up and down. But in general, you're trending nicely up, and you just have to be patient. They're not really in the revenue phase of getting of these things. So when the money starts coming in, they'll look a lot nicer. But also, going back to the same thing, you have to be realistic about biotech, because the bigger they get, the lower their PE goes. So not these guys, they're so small, but some of these companies, they double in revenue, and they're making twice as much money, but their freaking PE goes down in half. It's a weird sector, believe me. It's like the little ones can have 300 PE, but the big ones who buy the little ones, they get PEs of 10. It's very, very odd business. This is your last drug, apparently. Report down 7% is a time to buy. Well, I like it a lot lower than this, so I don't know if I'd be jumping right back in on one pullback. We already sold after report a while ago because they went up so much. Yeah, I mean, you say 7%. Look, this shows 6 at the moment. I guess it was 7% off the high. What's down 7%? It's up from where it was 2 days ago. It's certainly up from where it was a month ago, and it's certainly up from where it was when I liked it. It was down here. I know this is where I was picking it when it was $5. I was telling people the freaking the money show last year. I was telling them, like, how could this thing be $5? They've got oil, they've got gold, and they've got copper. All those things are things people use. It's the weirdest thing. It really is. But anyway, so obviously they doubled. We got out around here. We were thrilled when they went up here, and we cashed that out trade back there. So to me, this is not a pullback. There's an established long-term range up here. And even if it was, it's still on top of that range. Look, again, there's thousands and thousands of stocks to trade. So when you see one up here, unless there's some incredibly compelling reason to do so, go to the next stock. Find one that's down here. If you buy your stocks when they're down here, obviously checking to see if there's a good, if you can see that there's some value in the stock, and going forward, they're going to fix whatever caused them to go there. But you find a stock down here and you like it, it goes up, and you're going to do the same amount of research. You're going to find the same crap out. You'll get the same differences of opinion and everything else on all these stocks. But you know what? When you find a winner, your percentage chance of winning a good stock when you start off down here on a chart instead of up here on a chart is astronomically better, exponentially better. Okay, you can't assume everybody who traded the stock for the last 2 years was an idiot. Millions and millions of trades went on for billions of dollars worth of stock from hedge funds and venture capital guys and people like us who are investors and inside people who know stuff, and all these people basically agreed that this is a 12.50 stock, and that's what, and frankly, that's what the 200-day moving average is for. This is a $12 stock. Millions of people looked at this stock and said, yeah, $12. Okay, it went out of favor for a while, it went in favor for a while, but on the whole, $12. It's all wrong. And yes, something changed since November from 10. Something did change, and that's why we're at 12 now, because this 200-day moving average was at 10. Now it's at 12. It might go higher, but nothing really changed in Freeport's business. Trump didn't actually pass any new laws. Congress didn't approve any new laws. Nothing has changed. We don't have import taxes. We don't know how they'd be affected. We don't know for sure the price of gold is going to hold up where it is. We don't know the copper is going to hold up where it is. I think Freeport, but to say that I would start at 16 expecting to make money, no. GE Butterfly. Why do we not have a GE Butterfly? I think because they have crappy premium more so than anything else. Oh no, they also pretty violent. They're kind of violent. So that goes back to the same thing. So, all right. Ordinarily, this is a pretty good chart for. I mean, ignore that. That would have been terrific. But this is a pretty good chart for Butterfly. I think the problem is though that you've got a variation of 20%. In a quarter, you can easily go up and down 20%. And I bet the problem is that GE doesn't really pay you that much. So if I look at GE, and for the step one, what do I think their range is? Range is, to be fair, we'll call it, all right, let's say 35 at the top and 25 at the bottom. Okay, let's say 25, 35 is the range we could live with. So, oops, let me do that. All right, so how much does it cost me to buy the spread? The 25 puts are $1.60. The 35 calls are $1.30. I don't see how this is that bad, actually. And then what would I sell? Let's say we sell the, oh, yeah, here's where it all falls apart, though. Yeah. So I'm spending only $3 or a little bit more. Let's say we're spending $3.50 on the longs. But look at this. I mean, if I go out for a quarter to April in 86 days, even if I sell the 30 puts and calls, I'm only going to collect back $1.50. But then I know I'm going to be wrong, right? I'm going to be wrong in one direction or the other. And the problem is, if you look at GE in a quarter, when don't they move more than $1.50? I'm enough to be comfortable with where they're going to be. And so if I'm only collecting $1.50 a quarter also, it means I'm going to collect $6 for the year. So if I collect $6 in a year, but they often have 20% moves, it means I can get burned for easily for $5 or $6. And that means the whole position would be a waste. So therefore, it's too tight to play. So like I said, shitty premiums. The premiums aren't good enough in the short term to make it an exciting trade. Ooh, I think my mouse is upset that it's burning out of batteries. Okay. Oh, yellow light. I find that interesting. Like a lot of electronic devices, when the battery runs low, a light comes on to tell you the battery's is low. And I'm like, well, isn't it using more battery? Like, why would they do that? Check the futures. I hope it's good news. Probably not. Ah! All right, hang on. Thanks for telling me that. No, that's not so bad. All right. Remember what we're looking for, 22.93.25. Oil's coming down, that's good. Dollar's coming up, that's good. Okay, I don't see any reason to get out of this right now. So my checks, okay, my checks are in my favor. Oil's coming down, bad for a couple of Dow components, and the dollar's getting a little stronger, bad for everybody in general. And also, we never broke over my limit of 206.16, so far so good. Although, really right on the nose of the S&P. And again, they're a good short here too at this line, just because that line is it's not that usual for that line to break. And obviously, Dow's already over it, but we know the Dow is silly because one component can push it one way or the other. But the S&P is a little bit more balanced. All right, so we talked about why GE doesn't make the butterfly. Any thoughts on up? I mean, I don't think it's a good mover. I don't like playing dollar futures either. I think here's the problem. It's down now. I think this is probably as low as the dollar will go, but there's the CF if you keep playing it. And what's your goal? Because I don't think the dollar's going to go higher either. So you're playing like a dollar. You know, that's your swinging up. It's almost certainly not going to go below 25.50, which is the 200-day moving average. It's almost certainly not going to go below 25.50. And I don't think it's going to go higher than 27. So you're playing such a tiny range. And it's a thinly traded option generally too. So I don't. So that's why we don't play. We have played it. We played it when it was super low. Back here, we played up in the in the spring because I said that was stupid. 24, I could see the upside to 26, and we made a play, and we made it. Again, I think we did a dollar spread, and we literally bought a $1 spread for 50 cents on up. But there, I thought it was stupidly low. This is low, but this would be stupidly low. This is just low. And there's a difference. The difference between low and stupidly low is if you pick only stupidly low, you'll be right 65, 70% of the time. If you just pick low, you'll be right 50% of the time if you're lucky. And it's not worth it because you're tying up the money. If I tie up $10,000 and I win six, not six, out of 100. If I win 55 out of 100 and lose 45 out of 100, I'll come out a little bit ahead. 10%. Let's say I come out. I start with $10,000 and I end up with $11,000 at the end of the year. I made 10% profit. Okay, but if I start out with $10,000 and I make only bets that are 70% likely to win, and I end up winning 70 times and losing 30 times, I'm going to make a lot more money, a real lot more money. And maybe I'll play less often, but that's okay. I don't need to play more often because the only person who gets rich for me playing often is the broker. You don't need a day. You don't have to have a thing like, it's like my daughter when she goes to the mall. Like the money's burning a hole in her pocket. She can't take it. If she has money, she has to find something to buy. It drives me nuts because my one daughter, my little one's like that. My older daughter, she would not spend $1. She's going to be so rich because she doesn't spend money on anything. I gave her, I opened up because she started driving. So I gave her, I got her a card, a bank card thing, a debit card. And she had $100 from her birthday, and I put $1,000 in myself, so she had $1,100. This was in July. She's got like $10.45 now. She spent like $55 since July. I mean, she has other money that flows through, but I'm just saying, as far as tapping her own money, no freaking way. Has to be a life and death emergency for her to tap into her own cash. But my other daughter, Jackie, she always has zero. She has whatever comes in the mail or whatever she gets from a gift or something like that, she has it until she can go somewhere to spend it. Yeah. So anyway, that's, don't be like that with stocks, okay? It's like you only buy when it's fantastic. Only buy one that you really want, that you say this is so much better than 100 other ones I'm looking at. Those are the ones you buy. You don't go out looking to buy a stock every day. You don't go out looking to spend money every day. Because you'll buy junk. And you don't buy in a bad market. You don't buy in a bad market. In a topping market. This is a topping market. You should be much less encouraged to buy. I've sent out many less top trade alerts recently. We've been a lot less active because I don't trust the market up here. And if I don't trust it, I'm not going to play it. Okay, the reason I have a fantastic winning percentage in my picks is because I don't just make picks for the sake of it. And this is why, by the way, all these services that guarantee you like 10 picks a month or 5 picks a month or whatever they guarantee, that's bad. And I know I make more picks than that, but I'm just saying, though, when you guarantee somebody that you're going to get a certain amount of picks every month, that means they're forcing themselves to make picks, whether they're good or bad picks. That's why I don't like to do things monthly. I don't like to have standard things. I don't like to do the same thing all week. You start getting into that kind of rut, and you say every Wednesday I'm going to have my trade of the week or something like that. That's a terrible thing. What if you don't have a good trade? All right, let my trade of the year, right? I did not have a trade of the year in October or November, and the TV people called me up and they're like, do you have a trade of the year? Do you have a trade of the year? And I'm like, no, not really. I don't really have something I'm comfortable with. And I only just last week went on TV and told them about silver wheat, which I did actually figure out on December 25th. But it took me until December 25th to figure out what trade was going to be our trade of the year. And I really started like in Thanksgiving, starting to look at things like seriously before Thanksgiving. I was looking at stuff. But if I had a deadline, if I imposed my own deadline and said, "Oh, I'm going to definitely pick it by December 1st," that's a terrible idea because I wasn't sure, I wasn't comfortable enough to make that pick. And we have never had a trade of the year that didn't make its whole thing. And generally, that whole thing is 500%. Because I take that really seriously. I make sure it's a trade that's absolutely incredibly good chance of making money. And when you're buying stocks, why would you do less? Why would you have lower standards for your portfolio? All right, now in our portfolios, I do buy things that have balance. So sometimes I'll take a chance, and sometimes I'll buy something that's going to be good in the downturns. I don't expect every stock in the portfolio to be a winner. I mean, some of them are betting against each other purposely. But that's all about the balancing act of the portfolio that we talk about sometimes. So the whole portfolio, yeah, you can pick a few stocks that are speculative or pick a few stocks that are contrary to your main part of your portfolio. But the stocks you're picking that you're intending to stick with, they should be like, it should be like if you're adopting a child. It's a major decision you should make that you take very seriously. Not just, this one, they fell 2%, so I'm going to buy it. That's not how it works, or it shouldn't be how it works. Okay. Talk about that. Okay. What time is it? I don't have. I literally only have like 15 minutes. Server diarrhea? Oh, my server had that one. It was bad. Overall spread is 10. Don't pay more than 5. Yeah, generally. I really don't like if they're not going to pay me 100% to hold my money for a year. I'm not that interested. I mean, look at our options opportunity portfolio. We can do better. Okay, we're up 140% a year. I mean, we know we can make more money than that. It's obviously 100% a year is great, but you don't know for sure you're going to make it. It's firepower, and you're going to take your shot, and it's either going to win or lose. But that's if you're going to get 100% back. If you're putting in 12 to make 15 and to make a $3 profit, the hell? Why are you tying your money up in something like that? ES on high day, new highs for ES. Oh no, this does not sound good. I don't want to look now. You're making me sad. 2293. All right, but oil's still falling. I'm happy about that. Dollars are rising. I'm not getting too many signals to tell me things are going to go badly for me. And again, I said my number would be 2016, 20,000. And we're not 5150 here. That's a good thing. Although I feel we are at 5150, I'm totally screwed. Albo Nikkei, holy cow, 19.3. Damn, and you see the problem is you can't short the Nikkei because the dollar goes higher, the Nikkei goes higher. Oh, look at Apple. Oh, just under 122. This Trump guy is the best. He's freaking amazing. All right, silver down, still below 17. Gasoline down here, and natural gas all over. Holy cow, look at this natural gas thing. That's crazy. All right. My thoughts on RSX. You know what? RSX was interesting. I should have gone for that in the election because obviously Trump is pro-Russia. So as soon as he won, and again, I'm not talking about the Putin bullshit, Putin puppet crap and whatever. He's pro-Russia compared to Obama. He's pro-Russia. So therefore, that was an easy bet. That was an obvious, easy thing. You look at a couple of things like that. Oh, that's what I want to talk to you guys about. Okay, we don't have any more questions. This is a really good article. It was from Tuesday's member chat at 12:45, and it's from, well, we'll find out in a minute. This is MarketWatch. These 85 stocks are now on the buy list as Donald Trump takes office. Okay, it's my intention, and I'm not going to probably add up this week, actually. We've got a lot of crap going on. But it's my intention to go through this list and pick out a few that we really like. But let's talk about it for now. Okay, so what companies should do well given what we know about Trump? This is a nicely thought out article giving some reasons and so on and so forth. So for one thing, read it no matter what. That's what I'll say. Protectionism, yes. For better or worse, like this guy's really on the ball. I like him. Who is he? Michael Brush. Okay, so he's really thought this out nicely. I like it. And so relative boost, strength of the dollar, reduces reported earnings for companies to get much of their earnings overseas. So he's really hitting all the points that make sense. He obviously knows the stuff. I hate that with the thing. All right, so many of them are in retail, blah, blah, blah. Okay. We like Lowe's because they're pure America. That makes sense. Target we like because they're too low. We talked about that in the butterfly portfolio. Dollar General I disagree with. I think if the economy is getting better, the dollar store is not going to do well, and they've been under bad pressure. CVS I don't like because Walgreens Boots is kicking their ass. Whole Foods I like, but I'm not sure if they're in a good place. Amazon I hate. Disney we just talked about. I like them. Walmart I like at this price. Altria, is Altria the one that has the freaking American cigarettes? I don't know. I get one's foreign, one's not. But the Philip Morris, whichever one is Philip Morris for sure. Well, it depends what happens with Trump and if they legalize pot or they crack down on it. But if they allow the legalization of pot to continue in this country, these guys are going to make a freaking fortune because eventually they're going to start selling it in stores packaged up nicely. And you think that pot smokers aren't going to want brand names, but yes, they will. They will go to the 7-Eleven, and believe me, 7-Eleven wants this, and so do all the supermarkets. They will go to 7-Eleven, and they will pay $100 for a box of joints. Think about the commerce. Think about the taxes. I mean, Colorado's already getting that benefit, but think about the money. The same, obviously, it's no harder to grow pot than it is to grow tobacco, and they can sell them for $100. That is going to be one popular thing. All right, public storage, Berkshire Hathaway, obviously, if the country's doing well, Berkshire Hathaway is doing well. Pioneer, nah, I'm not into these oil guys. Wells Fargo, we actually bought already, and they're having a nice run because they're not getting fined under Obama. The other financials are too expensive. Wells Fargo was the only one that was a bargain, but look what happened to them. Well, let's say I think. But Wells Fargo had that scandal. They're bastards. They're evil. But who cares? So, they had traded down and they had the thing, but then once Trump gets elected, everybody's like, they're not going to fine us. Nobody cares if we steal your money. Okay, so moving on. So again, the other financials are not cheap. Paychecks, that's not a bad idea because Paychecks is, they're good for people. If we have more jobs, then they're good. No, wow. Look at the rails came back. They were doing badly. I mentioned that this morning. So Intuit and The rails, yes, if they're not too expensive. Newport, somebody mentioned them today. I don't know if I don't like Newport. That's my problem with them. I did like Cliffs. I do like, I don't like USD. I like Cliffs as far as steel companies here. I like too is Metal. Well, it's hard to say with the tariffs, but I do like Metal in Europe, MTL. But I have to think about that as far as like if that's good or bad if it's tariffs. Because if we have trade barriers and Europe has trade barriers, then they benefit from their own trade barriers. What sector are we in now? Low labor costs. That makes sense. All right, so you're talking about, so they like Netflix for that reason. I don't like Netflix. D.H. Horton, absolutely. Pulte Homes, no. I like a Canadian, of course. You guys know that. Nike is not too expensive. Costco is always a good company. Host Hotels. Oh, there was another hotel. Well, there was another hotel. I forgot which one it was. Though. Apple, obviously, always great. Valero, I don't agree. I think their crack spread is bad. I wouldn't touch oil companies. Aflac is my favorite insurer. Excel, don't care about ABC. Gilead, Gilead keeps popping up. Celgene, no. McKesson, Express Scripts, yeah. Expeditors, I don't even know what they do. Archie Daniels. Well, where's Caterpillar? How's Caterpillar doing these days? I think they're too high. And Caterpillar just got too high. Yeah, I lost interest because they were so high. Pretty sure ADM's in the same place. Yeah, a little bit. Probably not as overpriced as Caterpillar at the moment. Companies that pay high taxes. Now that's an interesting one also. Goodyear's tricky because of the cars. They're slowing down a little bit. Robert Half, Gap, weird business. Under Armour, yeah, they're interesting. Nordstrom, no, I like Macy's better, but same concept. Here comes Whole Foods again, CVS again, so there's multiple reasons to buy some of these guys. Monster, no. Marathon Oil, no. Conoco, no. CME, not bad. T. Rowe Price is not a bad idea. Schwab, yeah, especially if the market keeps going up. I mean, those can be good stocks. Credit Suisse like Pinnacle Foods, that's interesting to look at. General Mills is always good. And again, we have some of these things. Bean Foods I used to like. I'm not sure where they are now. Lumis, no. Habitat Restaurant, no. Zoe's Kitchen and Pet, yeah, they're an interesting thing. Shake Shack, over. Oh my God, did we make a lot of money on Chipotle? That's been a great one for us. We have that huge spread on those guys, and I think we got even more aggressive, if I remember correctly. What am I looking at? As a long-term portfolio. Look how they broke up. Look at that. I was banging the table, telling everyone, buy Chipotle. And so we got, in the long-term portfolio, oh, here it is. Look at that. It's almost 150% now. Wow. Wait a minute. That's incredible. Oh, here you go. The long-term portfolio, 1209. And let me refresh this. So it's 1209 on, what date is this? Well, it was a little earlier than the 22nd, but whenever I reviewed it, it was about the 22nd. So a week ago, and now 1241. So that's up $32,000 since the weekend. So since Trump became president, this thing gained $32,000. We didn't touch it. It's the same for positions. Here, where are the long-term portfolio changes? Short-term. I know people always say, though, they want to see a new portfolio. I'm like, why do you not like these portfolios? It makes no sense. Options opportunity, no. There's a lot of positions too. Oh, here it is. So the long-term portfolio. I mean, what I'm trying to teach people with these portfolios is that you do leave your positions alone. They build over time, and if you balance your portfolio right, they start becoming money machines. This thing made $32,000 in 3 days. It's 80% in cash. All right, so here's the changes. The things that are in blue were changed. Nothing. None of our puts were changed. None of our dividend stocks were changed. Cliff, we're paying back the short callers, blah, 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 blah. We have to buy back the short callers. DBA, these expired worthless. Disney, we sold some calls because we wanted to lock in gains. Lumber liquidators, the short calls expired worthless. There's not like we did. So there was two things to do. We took two actions in the long-term portfolio. So effectively, nothing changed at all in this portfolio, and they made $32,000 in 3 days. So, what's good? What's a good way to start a portfolio? Buy this. Get these. It's a freaking amazingly great portfolio. It's incredibly well balanced. It's bullish. You need to balance it with the hedges in the short-term portfolio. But holy crap! I mean, that is incredible how much money you made doing that. What was I going to say? Oh yeah. So Chipotle. This is a bad way to look at it, but PNG. All right. So it was 405. In fact, this is a large portion of the game. It was 140 minus 33 minus 22, 55. So it was 85,000 net. And now it topped back up. And again, we're aggressive. You see, we only have the short put, the long call. We're only half covered on the long calls too. And now it's 153 minus 50. So basically, this position gained about $15,000 in 3 days. All right, and now it's gonna be almost time. See, 420. What's our goal? Our goal is like 420, isn't it, or 430? And look what we have. We have the 300 430 spread. And you say, wow, $100,000. Should we cash that out? No, because it's a $130,000 spread, and it could be more because we're not even fully covered. We have the $300 calls that we own, and we sold the 430 calls. So basically, it's 100% in the money now, and we have more upside. I don't know. I have to think about this one. So we've got, we've already got 100,000 out of 130 possible $1,000 on the spread. So we only can make $30,000 more, not counting the uncovered part. But I'd be inclined to cover something up. Actually though, if I sell 5 more calls, we pocket $40,000 almost selling 5 more calls. That's not a bad idea. We should probably cover the rest of these up, or we could take $75,000 off the table and sell the uncovered call. It's tricky. Taking $75,000 off the table is good. I don't know. We'll think about it. But anyway, so that's how that works. So these are our dilemmas in the long-term portfolio. How much money should we take? Exxon. Do I like Exxon trending? I don't like the fact that it's trending down, but I still like Exxon. I was just looking at them earlier. XON. I'm sorry. It's trending down, but it's not really. They split the company. They did a weird spin-off, and people are not. People like the new thing they spun off more than they like Exxon itself. So your shares that you had are not the same as they were. You now have to each share you have like 15% of some other company, and that it doesn't. If you have just the options, you can't tell because they haven't fixed the option prices yet. But you actually have, I would say, if you call it maybe $2 better, you're in $2 better shape than you think you are based on the stock over here. So anyway, and again, this is not their time of year. Their time of year is going to be back when the Zika virus starts getting the news again in March and April. That's when they're going to start moving back up because they've got one of the potential solutions for the Zika virus. If pot goes legal, go long on yum. Yeah, that's true too. So all the munchy foods, right? What percent qualifies as a tight stop regarding options? Well, that's an interesting depends because the problem is, first of all, it depends on what you're paying for your options. You know, if you're buying an option that's $5 and the bid-ask spread is 50 cents, so you could be losing 5 or 10% going in and out of the option. That means it doesn't make any sense at all for you to have a 10% stop. Just buying and selling the thing costs you 10%. So your stop would be at least 20%, or what the hell are you even getting in it for in the first place? So, you know, you have to just realize options are very volatile. And they are going to go up and down. That's why I'm not an option strategy guy. I'm a fundamentalist, okay? I buy stocks, and I have a target in mind when I buy the stock, and I use the option to minimize my cash outlay and to also to give me more flexibility in picking my targets and moving my targets. In other words, instead of buying a stock and always having to remember what my target is and what I thought it was going to do, I buy options, and it tells me right there. I can see exactly what I thought it was going to do because I had the number right there. Okay, like with Chipotle, like, you know, 430 was my goal, so now we're at my goal. That's nice to remember. It's like helps me remember, oh, gee, this is where we should probably do something. Now we're at my goal, and we still got to wait a year before we get paid. So, you know, as to stop, generally, you got to look at your allocation issues, too. If you're scaling in, and scaling is very simple. If you have a $100,000 portfolio, then your allocation block should be $10,000, no more than $10,000. If you have like under 200,000, your allocation block can be 10%. If you have over 200,000, your allocation block should really be should be 10%. Your allocation block should be 5%. So if you have $1 million, right, in your portfolio, you should be really playing a $50,000 allocation block, 20 of them. So your goal overall is to have 20 positions of no more than $50,000 at play. All right, or at risk. Doesn't mean you get to buy $50,000 worth of contracts that could wipe you out. So that's step number one, is have an allocation block. So if you have a $100,000 portfolio with a $10,000 allocation block, you then scale into your $10,000. That means your initial buy is going to be generally a quarter and no more than a half of an allocation block. So now we're saying that you're going to put down a $2,500 bet out of your $10,000 allocation block in your $100,000 portfolio. So if the entire bet gets wiped out, your entire first scaling in allocation gets wiped out, 1/4 allocation, you're only down 2.5% in your whole portfolio. Not that that's great, though. I'm just saying it only kills you by 2.5%. So the block itself, if it's down 20%, 25%, not a big deal because it's only down 25% of 2.5%. So like you're down 0.5% in your portfolio on that particular position. So even though that position itself is down 20-25%, because honestly, when it's down 40%, if you still like it, that's where you want to double down. When the option position is down 40%, that's when you might want to double down. You don't want to double down 20%. What's the point? Things go up and down 20% all the time with options. So if you're scaling in and you're intending to buy more and it's going down and you still like the stock, then when it's down 40%, that's when you say, hey, this might be the time to make my move. And we do that all the time. We take some horrific losses in the early rounds waiting for a good price. Like Gilead, frankly, like Chipotle. Chipotle went the wrong way on us, and we were like, fantastic, let's buy more. You know, when Chipotle bottomed out on the last round, we bought back 5 of the call, the short call. We took money out of our pocket, and I hate doing that. I hate ever buy back a short caller, but it was so cheap, I said, screw that, let's buy it and go naked. Have 5 naked longs. And that doesn't say, 5 naked longs doesn't sound like much, but in that position, it's $75,000. So you have to make decisions as to your allocation, your quantity, where you are, so on and so forth. So there's nothing more important than using that scaling in system, because early on you can do it. No position, so getting back to the allocation, no position should ever cost you more than 40% of your allocation. So in other words, in a $100,000 portfolio, you lose $4,000. You shouldn't even be in that position anymore. And that also means, though, that you have to take stocks that are proportionally right for your portfolio. You can't play Chipotle or even one share. I mean, you can't play a $300 stock if you have a $10,000 allocation block. It's out of the question, because you have to buy 100 of them. That's $30,000. It's not even a stock you should be in. You need to find $5 stocks, $10 stocks, $20 stocks the most. You don't mess around with expensive stocks when you have a small portfolio. You have to trade within your means. And then you won't have such a problem with stocks, because frankly the smaller stocks won't move as much and so on and so forth. But you've got to always think in terms of allocation blocks, and within the allocation blocks you're scaling in, and that way you always keep it under control when you're moving in and out of positions. That's the most important thing to practice if you're going to be actively moving, playing with a portfolio. The giant candle on CL has reversed, going up or down. Oh no, There you go. Damn it, should have bet that one. But there you go. See, that's working on my Dow. Here's my Dow. Here's my Dow. Well, not really working, but the Russell's coming back. That's a nice short now too. Under 1380 on the Russell is a good spot too. This is good. I think we still have those USO put to the shorts or something. What happened with NRF? I don't know what happened with NRF. What happened? All these, whoop. Oh, they're gone. I don't know. What does Yahoo say about that? Ooh, weird. What did happen? Apple's there. Oh, there they are. I don't know. What do you mean? Oh. I've answered your vague question. I don't know. All right. Oh, shit. I got to go, guys. Does the VIX help with the call spreads? I know it hurts with put selling. No, the VIX is what the VIX help. I know it hurts with put selling. Oh, the low VIX. It hurts because, generally we try to buy the call that has a lower premium, like we'll buy in the money call. We try to buy a call with less premium and sell the call with higher premium. So if the VIX is low, we're still the ones that are trying to sell the premium, and we'd rather sell more premium. So it's not the best. And another reason why we're less active right now as far as picking positions, because there's not good prices. I keep listening to things like that GE thing. I'm like, those prices suck. But when you find something that's like beaten down like Gilead, they have fantastic premiums because everybody thinks they're going bankrupt or something. You take a quick look at Target. We like Target. I know that for a fact. This is a very good spot to buy Target, and we went aggressively long on Target in the butterfly portfolio, which frankly we don't always go long there. Oh, and boy, was that a good call, huh? So we're basically aggressively long on Target at this price. I think it's a great bottom. It's just silly. I mean, it's retail is not dead. People like to shop. It's going to take a long time before people don't want to touch things anymore before they buy. CL breaking down, 52.50 should be some kind of resistance, yeah. All right, good job, conservative Phil Davis, my evil twin. So where were we? Did we finish this article? I don't think we did. Albacore, oh, you got distracted, didn't we? Restaurant, Bemis, International Paper, is that still a thing? God, I got the same ream of paper from, I think from like 5 years ago. I got a box of paper. And it's funny, too, with my old company, we used to, oh, God, I mean, it's only like 10 years ago. This company I own, we did real estate data. We used to buy paper in bulk. Trucks used to come and dump paper into our supply room. And to imagine, like, how little paper I use these days. My printer broke. I didn't even bother getting a new one for like 3 months. I literally had nothing. I think one time it came up that I need to print something, and the second time, 3 months later, is when I finally said, "Oh, I'll buy a printer," for like $150. It's crazy. I remember the first time a LaserJet was under 1,000. The little LaserJets, and I was so happy. Now it's like, God, kidding. Earnings repatriation. I'm not sure if I think this is such a good thing. I mean, obviously, it's good to get the earnings, the money back for free, but then what are they going to do with it? It's still money. It's on their books. It's not magic. So the thing is, do they have something good to do with it? If they go and repatriate their money and then do something stupid like buy some companies at 300 PE, then what's the point? I'd rather keep the money overseas where it's safe. So it depends on what they do with the money. That's when it becomes a good or bad thing. Apple, I think it's a good thing for Apple for sure, because everything's a good thing for Apple. But Apple having the ability to move a little, to move the $100 billion around and throw it into a checking account, they could do some damage with $100 billion sitting there. Lockheed Martin is one I like. I told you about Lockheed Martin, Raytheon, Boeing. Of course, I was making fun of people who were downgrading Boeing last week. I mean, it's ridiculous. They have a 10-year backlog. 10 years. 10 years. It will take them to make all the planes that they have on order now. If 30% of the people cancel, it will take them 7 years to fill the orders, and during that time, they'll get more orders. How do you short a company like that? I could not believe that people were saying, oh, Boeing's cycle is over. I'm like, how is it over when you have a 10-year backlog of orders? I mean, analysts are idiots. It's just amazing to me. It's really embarrassing to be called an analyst. All right, Vulcan, Martin, and these and all. I think we can do better on infrastructure than that. I'll have to look around. All right, anyway, so good. So basically my plan is to kind of go through these a lot more carefully and figure out like what's good and what's bad and come up with like maybe top 10 Trump plays, something like, top 10 Trump plays. Yeah, there's a good article title. So hopefully I can get that done. Hail Trump. Yes, that's correct. All right, I have to go. I'm going to leave these shorts because I just want to see what happens tomorrow. I really think this is all bullshit. We're at 22. See, I should have stopped out, though. We went over 22.93. I just really can't find a good reason to do it. That's all. Oil's coming down. The dollar's going up. Don't know. We're up a lot less than Europe was up. I think this is teetering now. Anyway, I'm going to leave it on and see what happens tomorrow. It'll be something fun to do tonight. That way I can check my thing and see if I'm making any money. So at the moment, though, should have stopped out. If I was playing this conservatively, should have stopped out. And we're down $130. So it's a good experiment. And by the way, that's why it's good to play. When you have a line like this and you can stop out, and like I said, this was going to be my definite stop out anyway, 2016. If all I can lose at 2016 is $250, but if it goes back down to 19.9, I'm going to make $500. I have a 2-to-1 reward to risk ratio if I think those things are equally likely. I think it could pull back here very easily. That'll make me $500 per contract. I did that wrong. It's $500 per contract. I mean $2,000 versus the potential $250 loss if I stop out here. So those are the kind of bets you want to make in the futures. You want to be very cognizant of what you can lose. You want to limit your losses, and you want to have a profit goal. And if you're right once in a while and you get this big win, that offsets a lot of little losses. But you have to have a discipline to it. And when you're scaling in, don't forget to scale out and get even. That's also very, very important. All right, sorry it's a short one today, but I have a meeting. Liberal never stops adding double. It's not true. It's just you know what it is. I have to really get that clarified because I play with such small amounts when I'm doing these webinars that I'm not, it's not interesting to me. It's like when you gamble and like if you go gambling, you have penny gambling or something like that. It's like it's not interesting. There's nothing to. It's not the point of gambling. Gambling has to be something. So for me, it's like to have 4 open contracts. It's like I really there's not much that the Dow's going to be able to do to me. It's going to make me upset. At 4 contracts, and I would be happier to have 8 or 12 or 16 or 32 contracts short if it went up. So that's the problem. Is it's a scale thing. I mean, I understand a lot of people look at that and go, oh, $130. I'm like, it's just not enough. It's just not playing for me. Okay, $130 is like the commission I usually play on a trade, not the actual trade itself. So these lots that we're doing in the webinars are quite small generally. Well, so actually, what do we have? We have that one that was up and down $40,000 up here. I don't remember what it was. I think it was the oil. Was it oil last time or the Russell? I think it was both. But we have these big trades on oil and the Russell for a while. But anyway, it's just at this point for this amount, like I said, I can only lose if I stop out over 2016. I can only lose $250, and I think that if I stick with it, I've got a very good chance of at least coming back to here, which will make me $1,000. And if we get down to here, I make $2,000. Then I'm interested. But yeah, don't mindlessly double down. Okay, so you have to just always be aware of your risk and your reward, and make sure you keep them in line. And again, it goes back to proportion, right? A $500 loss or $250 loss, it's not going to change my day in the least. Okay, it's like I can make that bet 20 more times today, not worry about it. You've got to do things in proportion because you can't, if you lose money and that hurts you and you can't make another bet, then you're betting too much. You've got to keep things in proportion because you have to play the statistics of the thing. And you can't play the statistics if you let yourself get wiped out. You have to be able to make the next bet and make the next bet and make the next bet and play the odds over time. And if you can't, by the way, if one futures contract is too much and you can't afford a loss of $500 and that's going to knock you out for a week or a month or whatever, don't play at all then. It's not a good bet for your portfolio size. NRF became CLNS. Oh, how annoying. Anyway, so always keep things in proportion, keep things to scale for what you're able to play with. And we're going to talk about that much more in Vegas. So, by the way, we have that Vegas conference. If you go to today's post, if you want information on it, you can go over there. That's going to be February 11th and 12th, I'm going to say. It's that weekend. No. Well, 11th we all have dinner. The 12th we have the actual first conference day. And usually on the 12th I talk about general trading techniques and strategies and so on and so forth and the state of the overall economy. On the 13th we do live trading like this webinar all day long. We sit there, watch the market all day, we read the news, we figure out what's going on, and we make trades. It's really cool. So that's what we're going to be doing in Vegas on February, officially 12th and 13th, the 2 conference days at Caesars Palace, which is also fun to go to. All right, guys, thank you very much, and we will do it again next week. All right, take care, everybody.